But I'll point out that the critical ingredient to this is that every individual investor has their own way and should deal with their own individual investments in the context of their personal situation. That I can't know, and I don't pretend to know that, but that's why I like working with our advisors. That's why I choose to work in an environment like this, because I know we have advisors who will sit down with you and go through purpose that you have for the money, attaching time horizon to it, and then structuring along these guidelines so that we're getting a meshing of your purpose along with the structure of the portfolio. So this is a key way that I work with the advisors that you're talking to every day, so that we're putting together a structure in the portfolio that meets your needs, but it's also put together with a methodology that has a lot of research behind it. So I'm going to close off. This is the last section here is going to be about recession and recovery. So I'm still not to the answer of the question, is this a sustainable recovery? Because first, I would put to you, before we can understand whether it's a sustainable recovery, we have to know what we're recovering from. So you'll say, but Bill, we're recovering from a recession. And that, I would put back to you, is a very arbitrary description that really means 2 consecutive quarters of contraction in the growth of gross domestic product. The National Bureau of Economic Research in the U.S. announced to us a month ago that it took them a year and a half, but it told us that it ended in 2009. The U.S. recession ended in 2009. As far as I'm concerned, we're still not out of the woods, but recession is an arbitrary description of what the economic situation is. But here's what I'll put to you. Unless we understand what we're recovering from, it's very difficult to postulate whether or not this is a sustainable recovery. So, what are the different kinds of recession? The first one is income shock driven. This I would call a typical recession. It's typically short-lived and shallow. We'd say there's not a huge decline in gross domestic product, and it doesn't take long to recover from it. It's basically asset prices go up for some reason. Inflation. Central bankers say, no, too much inflation, that'll stifle growth. We're going to raise short-term interest rates, which does stifle inflation, but it also stifles growth short-term. So this is the secular nature of it. Stifles it for a while, businesses come back, and growth comes back into the picture. Typically, as I said, short-lived, but shallow. Businesses respond typically to this kind of income shock recession by taking expenses off their income statement. They fire people, they start cutting back on certain discretionary expenditures. The critical thing here is to recover from that kind of recession, you just hire people and you put those expenses back on as revenues start to build up again. That's why they're short and relatively shallow in terms of their impact on the economy, because it's easier to recover from them. The next kind of recession is less frequent. It's a single sector recession. Good example of that would be the dot-com bubble, 2000-2001. It hits hard and it's short. Bounces back very quickly. V-shaped recovery just means drops significantly, comes up just as quickly as it dropped. And that's what happened to us in the early part of this decade, is that we saw that happen very quickly. So that's an example of a single shock recession. The third type, and this is not a very nice one, but this is the exogenous or external shock recession. And that comes about from something outside of the realm of the financial system. And the best example of that is the OPEC price spike of the early 1970s. So 73 to 75 was almost as deep a recession as what we've been through recently. It was longer, but the net drop in GDP for that recession was 3.2%. What we've just been through is 3.9%. So close to what we've just been through. But that's the third type. It's something happening outside of the financial system is impacting what's going on with the economy. So what I'm going to put to you is, that's not what we're recovering or trying to recover from today. What we're trying to recover from today is a balance sheet recession. Now what that means is, instead of just businesses find that to recover from it, instead of just or respond to it, instead of just letting people go, cutting down expenses, it's not enough. They have so much of a lack of confidence in the future, they start taking assets off their books, productive assets off their books, just as a preventive measure. So they don't have to pay out as much in interest payments. And it's also a way to conserve their capital for the future. The evidence we have of that right now is that corporate America has unusually high levels of cash on their balance sheets. So you may say, well, that's pretty good, isn't it? They're still relatively healthy. Well, the answer is maybe. How productive is cash as an asset? Almost zero, especially with low interest rates. It's safe in the sense that you feel like you're well off, but it's not productive. So the real idea behind the balance sheet recession is it's a longer recovery period to it, and there are different methods of coming out of a balance sheet recession that work. And this is what gives me confidence that even though we're recovering from a balance sheet recession, that we'll be able to recover from it is that the people involved in trying to make decisions related to that understand what's going on. Because the only two examples we have really to study of a balance sheet recession are Japan in the 1990s and the Great Depression. And that's when businesses in both of those periods of time took assets off their balance sheet. Their assets and liabilities got out of whack, so they started taking liabilities off their balance sheets. What we learned from that period of time was it's not enough just to adjust short-term interest rates. Central bankers can't do it alone. They can't help that recovery along by adjusting short-term interest rates alone. So what do? Quantitative easing. That's great jargon, isn't it? What it really means is that instead of just relying on short-term interest rates, central bankers start buying government securities. So think about what that does. It puts money into the marketplace. It provides liquidity to the marketplace. And that's a way that the central banks can start to influence what's going on in the economy outside of just how they adjust short-term interest rates. So when you hear quantitative easing, and you will hear more about it, because the Federal Reserve is going to start another round of quantitative easing because they learned from Japan, and Chairman Bernanke had as his doctoral thesis a study of the Great Depression. He knows what happened. By the way, there was a robust period of growth in the U.S. from 1933 to 1936. It was a huge growth spurt right in the middle of the Great Depression. What happened was, in 1936 to 37, it dropped right off the shelf again. We went into another deep recession that ended up being, in all told, a depression. But what happened was, at that period of time, this is interesting context because it drives what's going on in the decision makers' minds. In 1936, politically, Franklin Delano Roosevelt came under a lot of criticism for all the money he was spending on the New Deal. That's what drove the growth. But politically, it became untenable. So essentially, the Federal Reserve took the stimulus off the table. And that drove the economy right down again. Very severe drop, very quick drop. So what we're seeing now with quantitative easing, we're seeing the approach of central bankers saying, we've got a way to fight this. And that means throwing a lot of money at the market, putting a lot of liquidity in. Danger there, potentially inflationary. The positive side of that is because of the understanding that those central bankers have of the impact, that they can pull quantitative easing back by selling back those securities they bought, those government securities, into the market. So what do recessions look like? So here's a slide that's in your book, so if you can't read it here, don't worry about it. But this shows recessions from 1947 through 1977, and it says we had about 6 recessions during that period of time, and you can see the variances in GDP growth rate over those periods of time. This is the OPEC oil shock right here. So again, very long-lived and hurt us pretty badly because it pulled so much productive capacity out of the financial system. And this is what it looks like just over that 73 to 75 period. So we dropped down and had significant drops.